In today's fast-changing business world, focusing only on short-term financial results is no longer enough for long-term success. Companies that concentrate just on quarterly earnings often miss out on important strategic investments, innovation, and building trust with stakeholders, which can hurt their future ability to compete. Instead, businesses that aim for long-term value creation focus on building lasting economic, strategic, and social value over time. Long-term value creation models help companies understand and manage how they deliver this lasting value by combining financial performance with strategic positioning, operational excellence, innovation, and growing attention to environmental, social, and governance factors. These models encourage a shift from chasing immediate profits to generating sustainable cash flow, resilience, and competitive advantages. This presentation will explore these models in detail, covering their concepts, practical applications, design and implementation, real-world examples, benefits, and challenges, and why they are vital for modern business strategy and finance. Essentially, long-term value creation means generating sustainable economic returns that surpass a company's cost of capital while staying strategically relevant and maintaining stakeholder trust. It involves not just accounting profits, but also sustainable cash flow, competitive advantages, growth opportunities, risk management, and intangible assets like brand, culture, and innovation capacity. The image here, showing small plants growing from stacks of coins, symbolizes this gradual, steady growth of value over time. Long-term value creation models bring together strategy, operations, finance, and governance in a clear framework that shows how value is created, protected, and grown over time. These models offer practical benefits for businesses facing complex and uncertain environments. First, they help align corporate strategy with long-term goals, ensuring that investment choices and resource management support sustained value rather than just short-term wins. Second, they promote discipline in capital allocation by focusing on returns that exceed the cost of capital, allowing companies to balance investments, dividends, acquisitions, and debt reduction efficiently. Third, they improve governance and accountability by providing boards and leaders with clear logic to evaluate decisions based on their long-term impact instead of immediate financial results. Fourth, they boost investor confidence because investors favor companies that clearly communicate their long-term value creation strategies with transparent metrics and steady execution. Finally, these models build organizational resilience, helping firms better endure economic fluctuations, technology changes, and competitive pressures. Multiple well-known models are commonly used to guide this long-term value creation in practice, often combined to suit different business contexts. The discounted cash flow model is fundamental to understanding long-term value creation. It looks at value as the current worth of future cash flows the business expects, adjusted for the cost of capital. Key factors here include growing revenue, maintaining strong operating margins, using capital efficiently, keeping the cost of capital low, and sustaining a competitive edge. Essentially, creating long-term value means steadily increasing cash flows while managing risks and capital use wisely. The economic value-added model focuses on whether a company's profits exceed its cost of capital. By calculating net operating profit after tax minus the cost of capital on employed capital, it helps managers decide which projects truly add economic value, avoid growth that doesn't create value, and improve how capital is used. Lastly, the value driver tree model breaks down value creation into specific operational and strategic factors like revenue growth rates, pricing strategy, costs, asset turnover, and capital intensity, allowing a more detailed view of what drives value in the business. Together, these models provide a comprehensive approach to linking a company's financial strategy and operations with its long-term value creation. By linking operational metrics to financial value, this approach shows how everyday actions contribute to long-term results. Strategic advantage-based models focus on competitive advantage as the key to creating lasting value. These advantages come from factors like cost leadership, differentiation, network effects, intellectual property, and scale through ecosystems. When a company can sustain these advantages, it consistently earns returns above the industry average. Intangible asset-driven models recognize that modern value creation relies more on intangible assets such as brand strength, customer relationships, data and analytics capabilities, organizational culture, and innovation capacity. These assets are crucial for long-term success but need ongoing investment and strong management. Lastly, stakeholder-oriented models expand beyond just shareholders, considering the interests of all stakeholders since long-term shareholder value depends on balancing these broader interests effectively. Creating long-term value involves more than just balancing stakeholder interests, it's about turning those relationships into real competitive advantages. This includes focusing on key areas like employee engagement, customer trust, supplier relationships, social legitimacy, and environmental sustainability. To design and implement a successful long-term value creation model, organizations need a clear and disciplined process. First, they must define what value means for them, including their target returns above the cost of capital and the time frame they are considering. This helps avoid confusion between just growing bigger or focusing purely on size instead of true value. Next, they identify the core value drivers that have the greatest impact, such as customer lifetime value, market expansion opportunities, operational efficiency, and innovation pipelines. Tools like value driver trees are helpful to map these out effectively. Finally, strategy and investments must be closely aligned with these drivers to ensure that growth investments build strategic advantage, cost-cutting does not erode value, and acquisitions create real synergies that support the overall value creation goal. Long-term value creation depends on integrating balanced performance measures that include financial metrics like net present value, economic value added, and free cash flow, alongside strategic indicators such as market share quality and innovation success, and non-financial factors like employee retention and customer satisfaction. Governance and incentives also play a key role, where management incentives should be aligned with these value-based metrics, avoiding an overemphasis on short-term earnings targets and promoting prudent risk-taking behaviors. We can see practical examples across industries. Technology companies invest heavily in R&D and platform scalability, often accepting short-term margin pressure to secure dominant future positions. Consumer goods firms prioritize brand investment, efficient supply chains, and innovation to maintain steady cash flows and market leadership. Infrastructure and utility firms focus on stable cash flows, regulatory relationships, and disciplined capital allocation to generate predictable returns. And private equity investors improve operations and strategic positioning over several years to maximize exit valuations. The advantages of these long-term value creation models are clear. They foster sustainable performance by counteracting short-termism, enhance strategic clarity to improve decision-making and organizational focus, and align interests with investors, creating a solid foundation for enduring success. Long-term value creation models tend to attract investors who are looking for stable, enduring growth, such as institutional and patient capital investors. One key strength of these models is resilience. Companies focused on long-term value can better withstand shocks and adapt when conditions change. However, there are some challenges to keep in mind. Measuring intangible and long-term benefits can be complicated, and it's often hard to capture their full value accurately. Balancing immediate financial demands with longer-term goals continues to be difficult, as short-term pressures sometimes conflict with future-focused strategies. Implementation is another risk. Without strong governance, companies might struggle to turn long-term plans into consistent actions. Additionally, market pressures can prioritize short-term results, which creates external challenges for companies committed to long-term value. In today's business environment, long-term value creation models are evolving to include factors like digital transformation, ESG and sustainability, data-driven decision-making, and ecosystem or platform strategies. These reflect how competitive advantages in capital markets are changing with the times. Long-term value creation models offer a clear framework that helps organizations maintain competitive advantage, strong financial performance, and trust among stakeholders over time. By concentrating on sustainable cash flows, economic profit, strategic positioning, and intangible assets, these models encourage businesses to look past short-term financial gains and adopt a more resilient, purpose-driven approach. While there are still challenges in measuring and executing these principles, companies that consistently follow them are better equipped to handle uncertainties, attract patient investors, and achieve lasting success. In today's world, where strategic resilience is just as important as profitability, these models have become essential for effective business leadership.